Welcome to the Deep Dive. We cut through the noise to get you informed fast.
Today, we're digging into PepsiCo's Q2 2025 earnings.
Yeah, and this one was pretty surprising. On the surface, maybe standard stuff, but get this. The stock actually surged. We're talking 6, maybe 7% right after the announcement.
That's huge for them. It's their biggest single-day gain in about, 5 years?
Exactly. And the headline numbers, they looked good. Revenue hit $22.73 billion, which beat expectations.
And the core EPS, that non-GAAP number, came in at $2.12, also ahead of what analysts were thinking.
Right, and this is where it gets really interesting for you listening. There's a big but.
There really is, because while those core numbers look strong, and remember, those often strip out one-time things to show the underlying business, the actual GAAP net income, it fell sharply.
Yeah.
Well, it dropped to $1.26 billion. Compare that to $3.08 billion the year before.
Wow. Okay, so what drove that big drop?
It was primarily one major thing, a hefty $1.86 billion impairment charge, basically a write-down.
Okay, hold on. $1.86 billion impairment. That's a massive hit to net income. So maybe explain that for our listeners. What is an impairment charge, really? And how on earth does a company report that kind of hit and still see its stock jump like crazy? What's the story investors latched onto?
Yeah, great question. So an impairment charge is essentially an accounting thing. It's a write-down on the book value of certain assets. In this case, it was brands like Rockstar Energy Drink and Be & Cherry Snacks.
So it's not like they lost that cash this quarter.
Exactly. It reflects a view that these brands might not earn as much in the future as previously thought. It's an adjustment on paper, not necessarily about current sales performance or cash flow right now.
Okay.
So the key insight for you here is that investors, they clearly looked past this accounting adjustment. They focused instead on what they saw as PepsiCo's, let's say, operational strength, their ability to adapt, especially to shifting consumer habits.
Right. It shows what the market prioritizes, especially now.
Yeah.
Different metrics matter.
Absolutely. It's about the underlying story sometimes, not just the JAP bottom line.
Okay, that makes sense. So if they looked past the impairment, what did they see that was so strong? What were the real drivers behind that stock rally?
Well, there were two main things lighting a fire under the stock. First, the CEO, or Ramon Laguarta, really highlighted what he called the away-from-home surge.
Away from home, meaning like restaurants, vending machines.
Exactly. Restaurants, vending, convenience stores, that whole channel. They saw high single-digit revenue growth there. And they apparently won some market share, too, like expanding their deal with Subway. LaGuardia specifically mentioned consumers shifting towards, quote, away-from-home calories.
Okay, that's interesting because, we've heard from other companies, maybe like Kroger or Campbell's, see more of a dine-at-home thing. So PepsiCo's seeing the opposite.
Yeah.
People are out and about more, grabbing a Pepsi and chips.
It seems like PepsiCo's really capitalizing on that increased mobility. Yeah. It's a contrast.
How sustainable do you think that is? Especially if, the economy tightens up a bit. Is this a long-term shift or just a rebound?
That's the million-dollar question, isn't it? It's definitely something to watch, but for Q2, it was a clear positive. And the second big driver, robust international growth.
Outside the U.S.?
Yes. Emerging markets, for example, saw 8% revenue growth, and the EMEA and Latin America food segments were both up a solid 7%.
So strong performance overseas.
Definitely. And, add to that a bit of a tailwind from a weaker U.S. dollar, which helps boost those international earnings when they're translated back. It all painted a pretty positive picture operationally.
Okay, so strong away from home, strong international. But connecting this to the bigger picture, you still need to be aware of the pressures, right? It wasn't all sunshine.
Absolutely not. You hit the nail on the head. Back here in North America, their home base, they actually saw volumes decline.
Volumes meaning the actual amount of stuff sold.
Precisely. Food volume was down 1%, and beverages fell 2%. Overall, their organic volume, which strips out currency effects and acquisitions, giving you that pure demand read, declined 1.5%.
So people in North America bought slightly less Pepsi and Fritos, even if revenue was okay due to pricing or mix.
That seems to be the case, yeah. And those impairment charges we talked about, even if investors looked past them for the stock reaction, they do still weigh on the official GAAP profits and, longer-term sentiment.
So it really is, like you said, a quarter with two different stories playing out. Strong market reaction, but underlying pressures. What does this mean for PepsiCo going forward then?
It really is a dual narrative. Q2 shows a strong market reaction, yes, driven by specific growth areas that currency help, but they're still navigating these volume issues at home and dealing with that.
Flat. Wasn't it supposed to be down slightly before?
It was. So flat is actually an improvement from their prior guidance, which, again, probably helped the stock reaction. It makes you think about what counts as a good quarter these days, doesn't it? It's not always about massive growth everywhere.
That's a really good point. Context is everything.
Yeah.
And this kind of steady performance, plus they have a decent dividend, right? Around 3.2%.
Yeah, solid dividend, consistent cash flow. It positions them as that classic defensive play for investors when markets feel volatile, somewhere relatively safe to park cash.
And they also talked about adapting, didn't they? Following consumer trends.
They did, mentioned a technical roadmap to get rid of artificial colors and flavors, and being ready with products using, say, natural ingredients like real sugar, if that's where consumers go, basically saying we'll follow the customer.
Okay, so wrapping this up then. A really complex quarter when you look beneath the surface.
Definitely. And it leaves us with a question maybe for you to think about. Given this surprising rally for PepsiCo, despite these mixed signals, the impairment, the volume dips, but also the growth spots, what does it really tell us about how resilient these big consumer goods companies are, and what are their critical next steps in such a dynamic global market beyond just these immediate wins?
What are those critical moves? Something to chew on.
Indeed.